So, how exactly do you finance the energy transition of the future when your current global empire is, well, built primarily on fossil fuels, right? It's probably one of the most pressing questions in the entire energy sector today. Welcome to this explainer. Today, we're diving deep into the strategy and the financials of TotalEnergies, looking really closely at how they're attempting to solve this exact puzzle. To really grasp the scale we're dealing with here, just look at this number, $27.8 billion. That is TotalEnergies' cash flow from operations figure from 2025. I mean, it is a massive, highly tuned financial machine. This sheer volume of cash, that's what makes their entire strategy possible. It is literally the fuel that powers both their current operations and their future ambitions. So here's our roadmap for today. First, we'll look at the dual energy strategy. Then we'll unpack the Q1 2026 financials. Third, the green transition reality. Fourth, cash flow and shareholders. And finally, number 5, the 2026 outlook. Let's get into it. All right, starting with section 1, the dual energy strategy, which is really the core mental model for understanding this company. You kind of have to think of TotalEnergies as a machine running on two completely distinct engines. On one side, you've got the legacy cash generator. Think traditional offshore oil rigs and massive liquefied natural gas carriers. But then, right alongside it, almost like an odd couple, you have the future power engine, offshore wind turbines. You see, they aren't pivoting overnight. No way. They're physically operating that fossil fuel cash cow right in tandem with their newer renewables. And that brings us to their central corporate mantra, which is more energy, less emissions. Now, I know, it sounds like a paradox, doesn't it? But this is the guiding philosophy they use to balance today's reality with tomorrow's climate targets. They totally acknowledge that the world demands more energy, especially in growing economies. But at the exact same time, they're actively trying to pull the levers that drive down the emissions profile of that energy. Okay, moving on to section 2, unpacking Q1 2026 financials, exactly where the revenue lives today. Now, you really have to notice the stark contrast between top-line revenue and bottom-line profit across these divisions. Just look at refining and chemicals, a massive $32.2 billion in revenue, but the adjusted net operating income, just $1.5 billion. Now, compare that to exploration and production. It only brought in $10.1 billion in revenue, but it generated a massive $2.5 billion in profit. So it clearly shows you exactly where the high-margin cash generation really lives in this business. But hey, definitely don't ignore that third segment. The integrated power division brought in over $6.1 billion in revenue in Q1 alone. So why does this matter? Well, because it proves that their newer energy initiatives are no longer just some small PR exercise, right? They have a multi-billion-dollar footprint that's gaining some really serious momentum in the real-world market. Which leads us perfectly into section 3, the green transition reality, taking a look at the less emission side. So the absolutely crucial point here is how they measure success on both of these fronts simultaneously. On the more energy side of the ledger, their metrics show some aggressive traditional growth. I mean, they're actively growing their upstream portfolio and keeping their refining utilization rates well above 90%. But directly juxtaposed against that, they've got concrete emissions milestones, keeping Scope 1 and 2 emissions below 37 million tons of CO2 equivalent and slashing methane emissions by 65% compared to 2020 levels. Let's pull that abstract data out of the spreadsheets and anchor it to the real world for a second. 1,000. That is the number of high-power EV chargers TotalEnergies has now officially surpassed in France. And they aren't stopping there for sure. They're on track to operate 500 full dedicated EV charging stations by 2026. This is the actual physical infrastructure of the transition taking root right before us. And of course, all of these corporate targets fundamentally change the reality on the ground. To actually make these new divisions free cash flow positive, the workforce itself is having to evolve rapidly. We're talking about a massive shift from a century of traditional resource extraction to now actively managing highly complex, integrated clean power grids. All right, on to section 4, cash flow and shareholders, tracking the life cycle of a dollar. Based on their 2025 actuals, we can see a nearly perfectly even split in how they spend their cash. You've got $17.1 billion allocated to capital investment, so essentially building tomorrow's business. But right next to it, $15.6 billion was handed directly back to shareholders through dividends and buybacks. It is honestly a masterclass in how management balances reinvesting for future growth against meeting immediate investor demands. And if you were wondering how management actually feels about that shareholder return, you really just need to look at their own language. They describe their dividend as sacrosanct.
That's a strong word. They are absolutely committed to a payout of greater than 40% through all market cycles, and that's supported by aggressive share buybacks. They basically want the market to know that returning wealth to the shareholder is a non-negotiable priority.
Now, to ensure they can actually pay that sacrosanct dividend, they keep a very close eye on their gearing. For those unfamiliar, gearing is simply a financial ratio that compares a company's net debt to its equity. Think of it as a health check for the balance sheet. TotalEnergies is targeting a gearing of around 15% by the end of 2026. So what does that mean in plain English? Basically, they are preserving a bulletproof balance sheet so they can weather any sudden volatility in the energy markets.
Finally, Section 5, the 2026 Outlook and their strategic objectives. So, here are the final key targets you need to watch. First up, net investments are going to hover right around $15 billion a year. Second, they're planning $3 to $6 billion in share buybacks, assuming oil stays around $60 to $70 a barrel. Furthermore, the ordinary dividend is jumping 5.6% compared to 2024. And perhaps most importantly, despite all of this transition talk we've covered, hydrocarbon production is actually expected to exceed their 3% annual growth guidance. So yeah, both engines remain fully fueled. Which ultimately leaves us with this final provocative thought. TotalEnergies is currently succeeding at running this dual engine. They're literally funding a massive green transition using an equally massive growing fossil fuel cash cow. But can this balance be sustained forever? Or will market forces, strict climate policies, and investor demands eventually force those scales to tip decisively in one direction? It really is the ultimate energy question for the coming decade. Thanks so much for joining me on this explainer, and as always, keep questioning the data.